Welcome back to the Dividend Diplomats YouTube channel. You've got your boys, Bert and Lanny, the Dividend Diplomats, guys, and we're here to talk to you about not one, not two, not three, but four dividend growth stocks right now because the S&P 500 had a very turbulent week as the inflation index came up worse than anticipated. The S&P 500 was down 5% ending September 16th, which means, Bert, what happens to our favorite dividend stocks?
The yields go up when the prices go down. So we get to buy some great high quality dividend growth stocks at a discount and hopefully lower some of our cost bases in some of these positions and have a chance to grow our income for less. That's the key. Grow your income for less. That's what it's about.
Exactly. We're here to talk about four dividend stocks with yields now at or above 5%. So looking at the high yielders, again, these are some out of flavor stocks possibly this year, really getting pummeled by all things in the market that are happening. Inflation, supply chain, you name it, Bert. And before we
I think also too, let's not forget, there's one place that started, the FedEx also sent the world kind of swirling here for a little bit too on Friday with their earnings release where they pulled 2023 guidance and they talk about a recession. It's got a lot of people thinking if FedEx is saying that there's a recession coming and they're handling all the shipments and all the orders from all the other companies, who knows what's next?
FedEx is ringing the alarm bell. They're hitting the red button, guys. But the only button that dividend investors are hitting right now is buy, because you have to consistently buy dividend stocks right now. You can't time the market. Bert and I are very much against timing the market. Consistently buy, consistently average down your positions. You're not going to win them all, but you might consistently win, period.
Look, you're never going to beat the market in the long run. It's just a matter of fact. So if you found a formula, if you found something that's worked for you, take your gains, don't get greedy, because in the long run, Mr. Market always catches up. Think about what was going into this month. All the reports were inflation were going down, inflation were going down, inflation were going down. So if you were trading off of that, you were looking at that news, inflation went up and it sent the stock market tumbling. So you just never know what's actually going to happen. That's why you can't time it. You focus on the fundamentals. That's why we built our simple 3-step dividend stock screener to evaluate stocks to kind of take the noise out of it, make it a formula to help us find stocks that meet our investing metrics all the time.
Boom. And with those metrics right now is the Dividend Diplomat stock screener. We're talking the price to earnings ratio less than the S&P 500, that dividend payout ratio preferably less than 60%, sweet spot being 40 and 60%. Dividend growth, we look at the growth rate on average over the last 5 years and how many years that dividend growth streak has occurred. Last but not least, we throw in the little curveball. The one that's in the headlines right now in this YouTube video is what that current dividend yield is, guys. And that's what this video is all about, because these all pay 5% plus on the stock you own.
Yeah, so let's jump right in, everybody. Let's look at these 4 stocks that we're going to talk about here. Get ready, get excited, get hyped. This first stock was just featured on our blog in an article that was written by Mr. Lanny over there, one of the dividend diplomats. This has been a polarizing one, Lanny. Number 1 is probably the most polarizing on the list in 2022. Would you like to do the big review?
Guys, we're talking about the stock that is opening up a massive plant here in the Buckeye State in Columbus, Ohio. OH, Bert.
IO 2-0 Buckeyes at this moment. Hopefully 3-0 by the time you're watching this video. Toledo shouldn't get in their way.
Oh boy, here we go. This is a $120 billion by market cap company. Their stock is down 45%, guys. We're talking about Intel. Yes, the iconic chip maker. Ticker symbol is INTC. Intel stock has gotten crushed since January 1st. Just absolutely dismantled.
They are now trading below $30 per share, a level that Intel hasn't seen in a long time, and has caused the yield to hit levels it hasn't seen in a long time. What's happened with Intel, just quickly ripping through the news, revenue's falling. They're losing market share in their current markets to the competitors. Their CEO saying this is the bottom. They're saying we hit the bottom. We hit the bottom. We're going to come out of this. We're investing. We're growing. But still, the market's a little skeptical today, which is why they're down 45%.
Very skeptical. This is a company. Are they done, or are they really building for the future right now?
That's what we got to find out.
Intel. Bert, have you been long Intel since you've owned them?
I have, and I've still been long on Intel, but I haven't been adding as much on the way down. Seeing it at its current price, though, it's not a bad time to possibly consider nibbling 1, 2, 5, 10 shares over the next few weeks while it's at this level to lower the cost base. I'm already in it, so I still agree. I still like their long term.
Bert's in it to win it, guys. So that earnings expectation right now, analysts keep adjusting down that earnings per share. Right now it's at 226, and that has continued to come down this year. They were trading at 29.24 on September 16th. So that price to earnings ratio is low, but it's not as low as what it used to be. It's at 13 times earnings, Bert.
Yeah, and then the second metric here, the payout ratio, because earnings are the earnings estimates are decreasing. The payout ratio is climbing a little bit here. Their annual dividend's $1.46, puts a payout ratio at about 65%. So it's much higher than the typical 40s that we will see with Intel, or we saw at the beginning of the year. But again, that's why we watch the payout ratio. If earnings have a reduction, how safe is that dividend? Even with earnings getting slashed this year, the payout ratio is still at a pretty manageable, safe level at 65%.
Exactly, guys. Still relatively safe, but as the EPS comes down, so does that dividend payout ratio. Bert, dividend growth, they've been doing it now for 7+ years. And technically, when you look at the chart of growth, it is up even further over the more than 7+ years. They had that one weird year where they kind of skipped, but they've been doing it at an average rate of 6.27%. But I do want to put that note out there that based on my analysis, I would anticipate very low dividend growth rate for the next 1 to 2 years, and probably the 2 to 4% range.
Yeah, it's going to be a while before you're starting to see strong dividend growth from Intel. Let's look at that dividend yield. What did we say the metric, the percent was at this video, Lanny? 5%, 4 stocks yielding 5%. Intel hit it right on the money. Their yield is 5% at this current level on the dot.
Guys, 5%, down 45%. Again, 12.94 PE, a 64% payout ratio, dividend growth for 7 years at over 6%, with the dividend yield at 5%, guys. Bert, what's that second dividend stock that yields over 5% that just increased their dividend?
You beat me to it, Lanny. I was just about to say they increased that dividend. This company announced it was actually a pretty, how do I say it, pathetic dividend increase. It was only 1.6% this year. Their competitors not doing much better in terms of dividend increase. Today, we are going to talk about Philip Morris, ticker symbol PM, tobacco giant, the international behemoth. This company, we talk about Intel having a market cap of 120 billion. Philip Morris is like, hold my beer, Intel. We're at $148 billion ourselves. I mean,
hold my sig.
Yeah. I'm going to put it out in your arm too, Intel, while we're talking about it. But yeah, Philip Morris, unlike Intel though, they've kind of held flat this year. Year to date, they're basically even. They're down 0.18%. 52 weeks, they're down 6%. They're beating the market. So that's always a positive sign here. Their stock price continues to hold below $100 per share, which is always an interesting point for Philip Morris.
Yeah, guys, when times are rough, cigarettes get smoked, and
sin stock. It's a sin stock that
this is the sin stock. Bring on the haters, baby. We're talking sin stocks on the DD channel right now.
Yeah, so let's jump into the PE ratio here. That first metric, 95.56 is the last close price at the time of this video. Earnings per share, $5.66. It's a PE ratio of 16.88. Lanny, tell us about that payout ratio.
So the dividend payout ratio, now that they pay $1.27 per share per quarter, or $5.08 per share per year, that leads to a very high dividend payout ratio. They are at 89.75%.
Yeah. Their dividend growth, we already mentioned that this year was a below 2% dividend increase. Last 5 years have been a little bit better, but not much. Their 5-year average dividend growth rate is 3.75%, but they've increased their dividend for 13+ years. Every year since we had the Altria Philip Morris spinoff, and the combined entity before that spinoff had a history of increasing its dividend too. So Philip Morris likes to increase that dividend annually.
Guys, they do it no matter what. And you know why? Because they're trying to also pay you while you wait for that maybe smaller dividend increase with a higher dividend yield, guys.
They're like,
As
hey,
you
let's wait here. Let's take a sig break. Do this while we get you your dividend increase.
because guys, they pay right now 5.32% on each share of stocks. Every $100 invested, $5.32 are coming your way. Pretty decent right now.
All right, everybody. Philip Morris, just to summarize here, PE nearly 17 payout, 89%, 5-year dividend growth rate, 3.75%. Increase that dividend for 13 plus years after the spinoff for a while before that with a yield of 5.32%. Lanny, stock number 3. What sector are we going to now?
Let's go to banking. We're gonna go head up north to our other buddy in North America, Canada. Bringing on Canadian Imperial, ticker symbol CM, one of the big 6 financial institutions, one of the big 6 banks. What a great stock to own and to continue to buy at these prices. Bert, trading at $47.72. They're down about 18.5% this year. You own them. I own a crap ton of them. And man, I love that dividend every time it hits that account on the drip, baby.
They're down, but they are not out. And we're going to show you why here when we start going through the metrics. Their PE ratio at a price of $47.72, forward earnings of $5.65. That PE ratio is 8.45x.
Only 8.5 times the market. You got to love the financial institution arena right now. A lot of value there. But to talk about that dividend payout ratio for Canadian Imperial, they pay around a $2.50, $2.60 per share per year, spread over 4 quarters. Just depends on that lovely exchange rate with that power of the US dollar right now. But their payout ratio is around 46%, give or take, definitely under 60% and probably above 40% right now.
5-year dividend growth rate is 4.5%. They've increased that dividend for 11 years, ever since they got out from underneath the financial crisis, like so many other financial institutions we've analyzed on this table. Strong dividend growth for one of the big 6. It's exactly what you'd expect.
Strong dividend growth, strong dividend yield. With that dividend payout of 2.5 to 2.6%, they pay out around 4.35 to 5.45%. So definitely well north of 5%, along with their other buddies we've talked about with Intel and Philip Morris.
Summarize the metrics here. PE 8.45, payout 46. 5-year dividend growth rate, 4.5%, 11 years of increasing that dividend with the nice, juicy, meaty yield of 5.45%. Lanny, let's round third. Let's head home. Surely Canadian Imperial with an 8.45 PE ratio has to be the lowest PE ratio on this list, right?
Well, let me tell you something, brother. There's actually one more stock that's lower on the price to earnings and higher on the dividend yield, Jack. We're talking about the stock that you just moved into, I believe, brother. We're talking about LyondellBasell, ticker symbol LYB. Yes, the chemical-based massive company at $25 billion in market cap. LyondellBasell's ticker symbol LYB. They're trading at $77.15, down 17% this year. Analysts are still expecting $16.50 in earnings per share. That leads to a price to earnings ratio less than 5.
4.6. It's wild. It's wild. It's funny. Their PE ratio of 4.67 is actually lower than their annual dividend right now of $4.76. Doesn't mean much, but it's still kind of funny just to see the numbers like that. Because let's talk about that second metric, that payout ratio. With that dividend of 4.76, that payout ratio is 28.8%. Low.
I mean, even if you cut EPS in half, the price to earnings is still low and the payout ratio is still low. And Bert, dividend growth, man, what's that looking like, my man?
5-year growth rate, 6.40%. Increase that dividend for 8 years. They are continuing to grow on the dividend growth spectrum. But you know what's also funny about that, Lanny? That 6.4% doesn't include that Hollywood Hogan leg drop of a special dividend that they had earlier in the year. So they're still rewarding you with payouts, even if it's not reflected in the annual dividend growth.
That's right. We usually take out those one-time, special dividends. But yeah, they always do surprise you every once in a while with that, baby.
Yep. So their yield Man, their yield after this terrible week for LyondellBasell, their yield is 6.17%. Winner, winner, chicken dinner on our list.
Guys, to summarize, LYB, 4.67 price to earnings, 29% payout ratio, 6.5% dividend growth for over 8+ years, and the highest yield out of them all on this video, 6.17%. Bert, rank yours right now.
Ooh, all right.
Big debate here.
All right. If I'm going to go in order, just looking at these four, keeping them to these four, because there are plenty of other great ones. All right. Number 1, Canadian Imperial. Number 2, LyondellBasell. 3, Intel. 4, Philip Morris at the moment. That's how I would buy them from top to bottom. And at the moment, I think I'd avoid adding myself Philip Morris at the moment. Any one of the first 3, though, I might be nibbling a share or 2 here or there. What about you, Lanny?
You know, Bert, I really like your order. I like Canadian Imperial as my number 1. I think Intel, quietly, I do want to add a few shares like what you said. You know, again, I'm going to try to keep averaging down a share or so here in the $28 to $30 range every time they're around there. And then obviously LyondellBasell, I'll try to nibble, and then Philip Morris. You know, so I would almost say like Canadian Imperial I'd like as like my top dog right now. And then really it's kind of like a tied mix between Intel, Philip Morris, and LyondellBasell, just because I own so much of all 3.
All right, everybody. Let us know what you think of these 4, but also let us know what other dividend stocks with a yield of 5% plus that you are watching today. We'd love to hear some other ones we should be considering. And if you haven't already, please subscribe to this channel. Give this video a thumbs up. We are so freaking close to hitting our next milestone of subscribers. So thank you, everybody.
Guys, let us know what passive income you've been adding to your dividend stock portfolio. What other stocks are there to buy right now as we are heading into a possible recession? Again, I still haven't said the word out there. The economists are just biting their tongue, I feel like.
Yeah, they're like, we're heading into a recession, but they won't actually say it.
Exactly, guys. But again, we appreciate it. Leave your feedback. Definitely like this video. That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.